Have you ever thought about how companies handle cleanup bills that are decades away? I'm talking about massive billion-dollar costs, like dismantling a nuclear power plant or restoring a giant mine. These are promises made today for a cleanup that's way off in the future. And believe it or not, there's a very specific set of rules for how to put that on the books right now.
So let's just put the question right out there. Imagine your company builds a huge factory. You know for a fact that in 30 years, you are legally required to spend millions to safely tear it down and restore the land. How in the world do you account for that future cost on your balance sheet today? Well, that's exactly the puzzle we're going to solve.
And here's our game plan. First, we'll look at what this future cleanup bill is all about. Then we'll get into the official rulebook, IFRIC 1. After that, we'll break down the two main ways to handle it, the cost model and the revaluation model. We'll even see how the simple passage of time plays a huge role. And then we'll wrap it all up with the one big takeaway you need to remember.
Okay, so first up, this whole idea of a future cleanup bill. This isn't just about accounting jargon. It's really about a promise. When a company creates something that will eventually need to be decommissioned, they're making a binding promise today for an action way down the road.
The official name for this promise is a decommissioning liability. This could be anything from taking apart an oil rig to rehabilitating environmental damage from a mine. Now, here's the part that might surprise you. Accounting rules say that the estimated cost of that future cleanup is actually included in the initial cost of the asset itself. So that expense, decades away, gets put on the balance sheet from day one. Kind of wild, right?
So, if that future cost is already on the books, you might be thinking, what's the problem? Well, things change. Estimates get updated, economic conditions shift, and that's exactly where our guide for today, IFRIC 1, comes into play. It's the official rulebook for what to do when those cleanup estimates change over time.
And let's be clear, this isn't just some friendly suggestion or a best practice. IFRIC 1 is the official interpretation from the International Accounting Standards Board. It's the binding guidance that companies all over the world have to follow.
Now, IFRIC 1 doesn't apply to everything. Its scope is pretty specific. It kicks in when these cleanup costs are tied to a physical asset, your classic property, plant, and equipment, or even a leased asset. And critically, that cost has to be officially recognized as a liability. So it's all about connecting the thing you built to the eventual obligation to unbuild it.
So what triggers these rules? IFRIC 1 wakes up and gets to work whenever that liability changes, and this usually happens for one of three reasons. 1, you get new information and your estimate for the final cleanup bill changes. 2, the discount rate you use to calculate its value today changes. Or 3, simply because time marches on.
This brings us to the two different ways a company can account for these changes. Let's start with option 1, the cost model. The best way to think about this is like you're adjusting the original foundation of the asset. It's a pretty straightforward approach.
Under the cost model, it works like this. If your estimated cleanup cost goes up, you simply add that amount to the cost of the asset on your books. If your estimate goes down, you subtract it. But, and this is a big but, there's a limit. You can't deduct more than the asset's current book value. If you get a massive cost decrease that's bigger than what the asset is worth, the extra bit goes straight to your profit as a gain. And on the flip side, if the cost goes way up, it might be a red flag that your asset is now overvalued, which could trigger an impairment test.
All right, now for the other side of the coin, which is way more dynamic. This is option 2, the revaluation model. Instead of a fixed foundation, think of the asset's value as more of a living, breathing balance that fluctuates over time.
Okay, this one's a bit different, so stick with me. Instead of messing with the asset's cost, changes here mostly hit a company's equity. Think of it like a special bucket in your equity called a revaluation surplus. If the estimated cleanup cost goes down, that's good news. The gain goes into this surplus bucket. But if the cost goes up, that's treated as an expense and it hits your profits right away. Now, there is an exception. If you have money in that surplus bucket, you can use it to absorb the cost increase first, which helps protect your profits for that period. It's a really dynamic system.
So let's just put them head to head to make it super clear. With the cost model, any changes to that future liability go straight to adjusting the asset's cost. Simple. With the revaluation model, those same changes flow through equity, hitting that revaluation surplus, or they hit your profit and loss. The choice a company makes here has a really big impact on how their financial statements look year to year. All right, now, for what I think is one of the most interesting parts of this whole topic, the effect of time itself. Remember, we're talking about a cost that could be 30 years away. That means the time value of money is a huge factor, and how we account for it is,
well, it's pretty clever.
So, let's imagine in year 1, after doing all the math, you figure out the present value of that future cleanup cost is exactly $1 million. Great. That's the number you put on your books.
Now let's fast forward 1 year. Nothing has changed. Your estimates are the same, the discount rate is the same, and yet the liability on your books has grown. With a 5% discount rate, it's now $1,050,000.
So where did that extra $50,000 come from? It's a process called the unwinding of the discount. It's just a fancy way of saying that as we get 1 year closer to the date we have to pay the bill, its present value naturally goes up. But here is the absolutely crucial part. That $50,000 increase is treated as a finance cost. Think of it like interest expense. It hits your profit or loss for the year, and it is never capitalized or added back to the cost of the asset.
So what happens when the plan has finally run its course and the asset is at the end of its useful life? Well, the standard is crystal clear on this one. From that point forward, it doesn't matter which model you were using. Any change to that cleanup liability, up or down, gets recognized immediately in your profit or loss. The special link to the asset is officially broken.
Okay, let's pull all these threads together. What does all of this complex accounting really mean at the end of the day?
Here's the bottom line. The choice between the cost model and the revaluation model isn't just a small detail. It fundamentally changes how adjustments to a future cost impact a company's financial statements today. This isn't a problem for another day. It directly affects a company's reported equity and profit right now.
And that brings us to a much bigger question. IFRIC 1 gives us a really solid logical framework. But does this whole process of estimating, discounting, and adjusting over decades really prepare us for the true final cost of the actions we take today? It's a question that really gets to the very heart of what accounting is supposed to do: measure responsibility.